And with our indexes under pressure today, I do want to bring in our next guest, have a more macro conversation about where we might be heading for the rest of the year. Joining us now, Dale Smothers. Dale, President and CEO of RDS Wealth Management. Dale, thanks as always for being with us. I'd love to just get your thoughts on the market action we're seeing and where we could potentially head by the year end.
Yeah, good to be with you, Marley. I think that this price action we've seen in October is the normal October. I mean, October has struck again. Historically, October brings a lot of volatility to the table, and this has not surprised us. We have actually prepared for this as a firm, knowing that October tends to be a little bit rocky. The headwinds that we're facing in October, clearly China is on the table. The uncertainties around China's trade war, that's one that has to be cleared up before we see this continue to hopefully go higher. The next leg up in the market is probably contingent upon the China trade deal. We also saw some real fear in private lending. This private lending smoke that we saw, we hope it's not fire that's systemic across the entire market, which I don't think it is. And when all of this subsides, I think November and December, again, historically a strong couple of months here, I think it takes the market higher. Our price target for the S&P 500 is right around 7,000 points by the end of the year. I think we've got a good 4% up from here. And this is all led by artificial intelligence spending that continues likely into the year, a strengthening consumer confidence and optimism around what is to come in 2026. And of course, the Santa Claus rally being exactly what it is on normal years.
All right, so you mentioned normal years there. We typically see September be a really volatile month. That didn't prove to be true, but we are seeing it with October. November, December, typically we get that Santa play, and it's generally positive for the markets. And if that proves true, we could hit that 7,000 you're talking about. But does anything feel different about this year's setup to you?
Yeah, I mean, this year, we call it financial winter, as a matter of fact, those 3 months. It's September and October is the back half of financial winter leading into Q4. This winter has been a tropical winter for sure. The AI spend has led us completely through these most volatile months of the year, September and October, and it's been higher except the China trade war. The China trade war is going to trump every bit, no pun intended there. It's going to trump what we would see typically taking place with the AI spin. AI spin has led the market higher, but China's trade war is the biggest variable on the table. Without that being cleared, I think we could see a lot of bouncing going from, essentially staying around the 6,700 point number, maybe even going back into the 6,500 point number if we're talking macro on the S&P 500. I do believe that China is the key going into the end of the year. Rare earths is the headline. Rare earths may be an opportunity for us to invest if we're wanting to be speculative. But if it's us as a firm managing money for our clients who can't stand to see that extreme volatility, we're buying household names. Some are tech heavy, some are options around other macro indexes like the S&P 500. I believe trading options here might not be a bad call for those who want less downside volatility.
All right, so outside of options, how should investors think about positioning themselves with the swings that we've seen in October and the potential volatility with all the unknowns around this China trade deal?
Marley, we've got to be taking advantage of the dips that we see in really good names. For the last 6 months, we've been kind of screaming a name like Apple, which has been lagging up until recent when it got clarity around its AI trade and the super cycle that comes from the iPhone 17. We have seen Apple trade very nicely in the last couple of weeks. I think we've still got a lot of upside still to be had in names like Apple. Household name, AI leader. We're going to continue to invest in names like Apple. Microsoft's another one. We hold these as core positions in growth-focused accounts. And if you want less volatility around them, or maybe you need income from those names, trading covered calls against those names makes a lot of sense. Another one we really like in this space, Marley, is Amazon. Amazon has been a laggard in the Mag 7 for some time, and Amazon made headlines with AWS going out over the last couple of days. It's been all over the news of people logging into websites and not being able to connect for some reason. Come to find out, it's because of AWS. AWS really is what makes Amazon Amazon. We all think of Amazon, Marley, as the big smiley faces on the boxes sitting on our front porch when we come home. The reality is AWS drives Amazon, and it is the biggest piece of its profitable machine. AWS will continue to lead Amazon higher. This outage didn't help it, but if anything, it maybe put it more in the headlines. I think Amazon starts to tick up a little bit higher over the next couple of months. Within the next 6 months, I think we're no longer talking about it as a laggard of the Mag 7.
All right, so
one other name.
Oh, go ahead. Outside of the Mag 7, who do you like?
This is where I was headed, exactly, Marley. One other name I like in this AI spending frenzy is CoreWeave. CoreWeave, buying opportunities that we present that present themselves in these dips that we're seeing right now in CoreWeave specifically, buying up names like CoreWeave or Applied Digital. For long-term speculative play in the AI realm, I think you're going to be very benefited from holding these names for the long term. CoreWeave is a revolution of kind of arranging artificial intelligence structures. Of course, the artificial intelligence build out, the spending that goes into that is going to benefit companies like Applied Digital. These are all names that we're putting into growth, speculative types of portfolios.
And with CoreWeave, what do you think sets it apart in the AI infrastructure race?
Yeah, so I think CoreWeave, I like to use this analogy with our clients. If the race itself, you use that analogy, I'll build on it. The race itself, let's call it a horse race. We've got places like Microsoft, let's say, Microsoft, Apple, Amazon, they're all racing, Google, trying to be the fastest horse. Well, most of those horses run really fast on the track, which we would call NVIDIA. So NVIDIA has been all the craze. Everybody wants to put their horse on the track of NVIDIA. And if we consider this analogy, CoreWeave is the horse trainer, making that horse run faster on essentially NVIDIA. You're familiar with the circle that's kind of taking place between a lot of these super scalers of CoreWeave, NVIDIA, Applied Digital. They're all kind of in that same race together, backing one another. Now, there are standalone companies that are not on the NVIDIA chip. But if you've got companies that are on the NVIDIA chip, they're likely using CoreWeave as a training resource to help that artificial intelligence learn a little quicker.
Dale, I love the build on that analogy, and thanks for those picks today and for the broad macro conversation. That's Dale Smothers, the president and CEO of RDS Wealth Management.